Monday morning, good morning. I'm Guy Johnson. I'm alongside Lizzy Burton. We're an hour away from the opening trade. So what do you need to know? London calling. Fresh trade talks between China and the United States begin in the British capital today. We're going to have the latest on that story. Plus, it's a big week for bonds. US inflation data and two key auctions captivating traders. And the LA immigration protests. We're going to keep you updated on another night of unrest in California and its implications for the US economy, Lizzy.
A very good morning, Guy. Checking in on these markets and the hopes over those US-China trade talks are powering Asian equities, but futures on both sides of the Atlantic actually pointing lower this morning. Euro-dollar at a 114 handle, and you mentioned those two key auctions coming up for Treasuries later in the week. We keep an eye on the most unloved part of the curve, the 30-year yield at 4.97%. The countdown to the opening trade starts right now.
Monday the 9th. Let's just think about kind of where we finished last week. A real high note. The US payroll data delivering a solid outlook for the US economy in terms of the labour market. What's going on there? We'll dig into that in just a moment. We saw the S&P finishing at 6,000. That's a pretty big line in the sand. This week, though, what is going to provide the catalyst? We've got a number of things to choose from. But agenda number one, Lizzy, this morning is definitely what is happening with these trade talks that are taking right here in London, taking place.
It's important to note who's actually coming for these trade talks.
Yep.
So we have Scott Bessent, the US Treasury Secretary, Howard Lutnick, the Commerce Secretary, and Jameson Greer, the US Trade Representative. Lutnick, the most important here, I think, because the Chinese are taking this as a signal that maybe the US is going to be willing to give some ground when it comes to export controls on tech.
Yep.
They're seeing that as goodwill. But then the bigger question as well is what's China willing to give when it comes to critical minerals? We've seen some giveaways over the weekend. Can they get something long-lasting?
So the key thing here is that this increasingly feels like it's not about tariffs. It feels it's more about what is happening on the trade restriction front. It's about chips. It's about rare earths. We're not even talking about tariffs here. We've got to get to that still. We've got to get over these big hurdles of what is happening in the semiconductor sector and what is happening in the rare earth sector before we can even get to that. And that does raise the question about the fact that we are going to need details here. The first talks that took place in Geneva didn't provide many details. This is detail stuff. And I just wonder what actually we need to see and how long it's going to take, therefore.
And that's why you had that Trump-Xi call on Thursday, but the Chinese so insistent that you need to have talks between lower-level officials, not the heads of state, coming together, because they are concerned about the details. But even just to get back to where they were in Geneva is going to be hard, because the low-hanging fruit are gone.
Absolutely. So the low-hanging fruit there was just the enormous tariffs that the United States have placed on the Chinese economy. That was easy to deal with. But what was clear, even coming out of that, was that we didn't know what the nuance was. And that, it seems so important. Like, trade deals take years to put together. This one looks like it's going to take years to put together. So just bringing it back to the markets, we got a big reaction when we had that announcement on that morning, when we saw the announcement surrounding the Geneva talks. Are we going to get a similar sort of catalyst this week from these talks, and how long do they last? These guys could be scheduled to be here for quite some time.
Yeah, and if you look at the bigger picture when it comes to all the deal making ahead of that self-imposed deadline, you know, they're not getting that far with India. Yeah. Japan wants the reprieves on cars. Yeah. You've got the legal fight hanging over everything. Just this week you could have the court rule on Trump's appeal. But then when you think about the China position again, you know, we had that China data this morning, and just underscoring the deflationary picture, basically, on the consumer and on the manufacturing sides, and suggesting she also needs to come to the table.
Absolutely. There is this possibility, and Val's been flagging this, of the fact that maybe Trump goes to China. That would be a huge, huge kind of revelation for the markets. Let's talk about our second agenda this morning, and that is what is happening with these bond auctions coming up a little bit later. I want to actually fold in kind of a bit more into the narrative here. So we've got big auctions, back end of the curve auctions taking place starting Wednesday with the 10-year. We've got a 30-year auction coming up as well. This is an area the market's become increasingly nervous about, just given the supply that we are seeing coming to the market at the moment, not just in the United States, but around the world as well. You've got to fold in also the data Friday, which probably puts the Fed on hold for quite some time. So the Fed's not going to be the kind of the catalyst to drag yields lower here. you've got this congestion surrounding supply, so that keeps yields, and we're back up to around 5% on the 30-year. All of this speaks to an elevated bond story, an elevated term premium story for quite some time.
Which puts the focus on the fiscal concern, shall we say, around the big beautiful bill again when it comes to these these Treasury auctions. But yeah, as we go back to the payrolls data, job growth moderating in May, the prior months revised lower. We've got more to come this week on Thursday when it comes to initial jobless claims. But as you say, pairing those Fed cut bets off the back.
So you've got inflation data as well to fold into the mix. So say the inflation data comes through hot, and certainly Bloomberg Economics is pointing us in that direction this week. So you've got a labour market that is holding up. We'll talk about immigration in just a moment. We've got a labour market that is holding up. You've got an inflation story that is gathering pace. You've got a fiscal story that is worrying the bond market in terms of the back end and what the supply story looks like. That's a pretty toxic combination. Despite all of that, you've got the S&P at 6,000, which, again, just is amazing in terms of what you are seeing in terms of the different markets telling different narratives. The bond market and the equity market seem to be telling very different stories at the moment. Yeah,
let's bring in those LA protests then, because it is going to be the fourth day of these anti-deportation protests. And you mentioned the market reaction. MLive suggesting that maybe a bit of that dollar weakness comes back to the protests because you're seeing these such dramatic pictures. There you are, but also, rubber bullets being unleashed, tear gas as well. It raises the question again about the rule of law in the US and how much you want to be holding US assets.
Yeah, it's just another reason, maybe. And this is obviously not a direct market story, but it just, again, speaks to this idea of uncertainty in America. I don't know how you price that. It's really hard to price uncertainty, but it just speaks to that narrative. It speaks to tension between one of the biggest parts of the US economy, California. It speaks to the tension around what is going on between the Democrats and the Republicans. It takes you back into Congress and the big, beautiful bill, or kind of what is contained within that and some of the uncertainties that exist within that as well. And it just speaks to this idea that foreign investors are looking at the pictures on their screens, and you can see how Trump is responding to this, how the president is responding to this. And it just speaks to this idea that, do I want to put my money to work there? Do I need to put my money to work there? And I think that's a question that international investors just increasingly are asking, and this is another reason for that.
Yeah, so Trump's sending in the National Guard to deal with the protests. It's the first time since 1965
amazing, isn't it?
that the president has deployed a state's National Guard without being asked by the governor. So, pushback, of course, from Gavin Newsom. And he's threatening to, withhold federal tax payments. Trump saying that he could withdraw federal funding because of the lack of cooperation. Newsom saying that California pays over $80 billion more in taxes than it gets back. But just the bigger picture, I want to say, on the labour market, can the US economy afford to lose migrants who arrived illegally but now live productive lives just to signal to others, don't come to America?
Absolutely. And you see what is happening in the labour market right now. It is remaining tight, which is a surprise to many. But this does explain, in some ways, some of that tightness. And maybe it keeps, obviously, a big focus on that and keeps the Fed maybe on the sidelines for a while. Let's talk about what we've got coming up on the show. Marika Blom, ING Research, Chief Economist and Head of Research, is going to be joining us very, very shortly. Lauren Van Billon is going to be joining us, Allspring Global Investments Fixed Income Portfolio Manager. Lots going on there. We need to talk about what is happening with the long end of the bond market and equities. Sharon Bell, Goldman Sachs Senior European Equity Strategist, is going to be joining us in the second hour of the show, Lizzy.
We've got a busy week coming up. Today, as you say, you've got the US-China trade talks. Tomorrow, it's the UK labour market data. Of course, we always have to take that with a pinch of salt, given the difficulties at the Office for National Statistics. But it proceeds on Wednesday, the UK spending review from Chancellor Rachel Reeves, also US CPI data, as we've mentioned. Thursday, we get UK GDP and US PPI and that US 30-year Treasury auction. And then on Friday, it's the University of Michigan consumer sentiment numbers.
This spending review in the UK seems to be going right down to the wire. The headline over the weekend seems to suggest that they were going to prioritise health and defence, but everything else is on the table in terms of spending cuts.
Yes, and Treasury officials trying to push back against this narrative that it's austerity, but our Phil Aldrich arguing, well, he had a great piece about how the problem for Labour is, are people really going to feel whatever spending raises Reeves announces, because the Conservative government made cuts so deep that, a former OBR boss called it implausibly deep. And so you kind of turning the heating up when you've taken people's jumpers away, if that's an analogy that works. You know, like you need to feel this if you want to bring voters back to Labour when, you know, you've got Nigel Farage's Reform Party surging in the polls.
So basically, while they have a massive majority, they have a thin kind of picture going forward in terms of the votes that they can take, and that's going to be the concern going into the next election. They're struggling on housing, they're struggling on spending, they don't know where to spend the money, how to spend the money. There's all kinds of challenges that are facing this Labour government at the moment. We'll come back to that story a little bit later. What else do you need to know this Monday morning? The group behind a humanitarian aid ship heading for Gaza says it has been boarded, the ship at least, by the Israeli military. AFP is quoting Israel's foreign ministry as saying the boat has been redirected to Israel. The Freedom Flotilla coalition vessel is carrying activists, including Sweden's Greta Thunberg. The group has attempted to reach Gaza and did so last month when it said the ship was disabled by a drone strike. Spain's main opposition party rallied thousands of people in a demonstration in the heart of Madrid over the weekend. The People's Party says over 100,000 people took to the streets calling for early elections after accusations of corruption against the socialist-led government of Prime Minister Pedro Sanchez. And Bloomberg has learned that Meta is in talks to make a multi-billion-dollar investment into artificial intelligence startup Scale AI. Sources say the financing could exceed $10 billion in value, making it one of the largest private company investments of all time, Lizzy.
Well, coming up on the programme, Prime Minister Keir Starmer is set to meet with Nvidia's Jensen Huang at London Tech Week later today. Our very own Tom McKenzie is going to be live from the event with the CEO of Octopus Ventures. Plus, we'll be staying across those protests in LA and we'll bring you all the latest developments as they unfold. But up next, as the FX debate rages on, has the dollar lost its dominance? We'll discuss whether it's the euro's moment, in fact. If you've got questions of your own, do send them in for us and our guests by going to IB plus BBTV Go. This is Bloomberg. We are 15 minutes into the programme, 45 minutes away from the opening trade. And this week, investors are going to be closely watching the US 30-year bond auction. It happens on Thursday amid concern around spiralling government debt. Bloomberg's Valerie Teitel joins us for more.
It's a big week for the bond market, but let's take stock of actually where the yield curve is after those gyrations from Friday's strong payroll report. Those two-year yields are trading above 4% for the first time in over 2 months. It's as we continue to price out that September rate cut from the Federal Reserve. Odds were at 90% before that NFP number. They're now trading around 70. In the long end of the curve, the 10-year yield is trading just south of 450 and the 30-year yield just below 5%. But it is a busy week full of risk events, starting with today, those U.S.-China talks happening in London. Wednesday, we have CPI and the 10-year auction. Thursday is PPI and the 30-year bond auction. It's kind of been funny how these auctions have now become a real litmus test for demand in the long end. After we've had a raft of weak bond auctions in the long end from Japan to Australia, this is going to be a key test for demand for those long end paper. I do want to talk about the key risk event for the U.S. equity market, and those are those U.S.-China trade talks happening today. I've got a chart behind me which pretty much sums up the reason why U.S. equities have rebounded so strongly from the lows, now entering a bull market up 20% from that April 8th, all to do with this trade policy uncertainty, this tariff policy uncertainty continuing to decline. And if that pace is going to continue, I think it does hinge on those U.S.-China trade talks beginning today in London.
U.S. equities up, Val, but the dollar down. We've got Schnabel talking about the fact that this is the euro's moment. Lagarde's talked about it. We talked to loads of people that are talking about the fact that actually that's the true tell on what is happening with U.S. assets.
Yeah, it's a great thing to bring up here. The euro has really outperformed this year, up some 12% versus the dollar. A lot to that to do with mainly the dollar move. But we did hear from ECB's Isabel Schnabel over the weekend saying this is a window of opportunity for the European area economically to capture on those dollar declines. But she does reiterate her need for joint debt issuance across Europe. That would be another key thing that would help European markets attract more foreign capital. That does come with a lot of sticking points for those member states' constitutions.
Valerie, thank you very much indeed. We'll come back to this comment in just a moment. We had, obviously, Starmer from Greece on the show on Friday talking about that. We'll play that sound in just a moment just to remind you of what he had to say. We're joined now by ING Group Chief Economist Marieke Blom to talk about this. Is it the Euro's moment? Is this the moment now that we need to be talking about the fact that we could see the exorbitant privilege of the dollar beginning to fade and the euro picking some of that up?
Yeah, well, we're not expecting a sudden sort of like complete fallout on the position of the US dollar. That's not what we're forecasting. But of course, it's all about relative strength, right? And if you look at the euro, the outlook relative to the US outlook has improved over the last couple of months, mostly because there's so much uncertainty in the US. And of course, this is also hitting the European markets, but to a lesser extent. And what we're seeing is markets respond to this, rethinking their positioning more towards the euro and less so for the US dollar. And I think mainly it is a political moment for Europe, because now Europe is seeing that there may also be reasons to have a bit of confidence in the future, because relatively speaking, again, the continent may not be doing that badly.
OK, do we need to see joint debt if that's going to happen? Is this the moment to maybe push that forward? There is clearly demand at the moment for European paper. But is there a demand for European paper in totality? Is it a zero-sum game? Do we need to see less German bond market issuance and more European bond market issuance?
That would be more attractive from a European perspective. If you have European debt, what we would expect to see is a deeper and more liquid market. And that market may also be attractive for example, sovereign indexes. What we're now seeing, if you look at EU issuance of bonds, they're not being seen as sovereigns. They're being seen as supranationals. And that means they're not being made part of the sovereign indices. We don't have real futures market when it comes to European bonds. And that would all help the European financial system. It would mean that there's more of a benchmark available for a European capital market. And we would expect to see more inflow from the rest of the world into European bonds as a consequence.
Marieke, let me just kind of bring the counter-argument to all of this, and that is that while we focus on the United States and its fiscal problems at the moment, Europe faces similar fiscal problems as well. I know you can park Germany and put it to one side, but France, Italy, to a certain extent Spain, still have issues with their fiscal positions. And I'm just wondering if this idea that maybe the Europeans represent a different story to the United States really holds water. Yes, the US is having a fiscal problem at the moment, but Europe has a fiscal problem as well. We don't have enough money. We've got too much debt. We've got too many challenges. Defence is one of them, but welfare continues to be another one as well. Why should Europe stand out and be different to the United States at the moment?
Yeah, well, it's a great question. And of course, living in the Netherlands, one of the frugal countries, I'm very well aware of the counter arguments. So what we are saying is let's start a debate again, and let's think about how you could do European bonds without the free rider problem that it can also lead to. So you have to think about conditionality. One way to think about this that we put forward, we also saw that Oliver Blanchard of the Peterson Institute of International Economics also put it forward, is to say, let's think about replacing a share of the existing national debt with European bonds. So let's say you do 10% of GDP, or you do maybe 25% of GDP, but no more. And in that way, you still have the market making sure that there is enough spread for countries not to increase their debt too high as a consequence of lower borrowing costs. And that way you can also explain to the more frugal countries that the risk of them suddenly having to pay up for those countries is lower.
Marieke, I get that the relationship between the euro and rates has somewhat been severed in recent weeks, but let me ask you on more familiar territory about your views on the ECB meeting last week. More hawkish than expected. Do you still expect more cuts, and if so, when?
Well, we actually do expect to still see more cuts, because we expect that the deflationary pressures are actually quite strong, and we would still expect to see one more cut by September, because simply said, inflation is coming down towards the targeted levels. We may still see that there is some wage pressure over time, so we don't expect to see more than that. But we still believe that the ECB may need to give one more cut because of all the deflationary pressures, right? With the strong euro that you just spoke about and low energy prices that may be warranted in the second half of this year.
Well, yeah, you talk about the deflationary pressures. Of course, we've got the US-China trade talks happening in London today. Is there a level of US tariffs on China that creates so much of a deflationary concern for the ECB because of the Chinese dumping that it would trigger?
Yeah, what we're currently mainly looking at is more the impact of what I just mentioned, right? So the stronger euro, cheaper energy prices. We may see a bit of that coming through, though. Of course, it may be that with a lack of demand from the US, Chinese companies are going to sell their goods more cheaply here in Europe. And of course, more in general, right? Also here on the continent, you will see that there's less demand from the US coming in. So that's also dampening the growth outlook, which may also dampen prices a bit. But we don't think that the China impact will be the most significant one.
Marika, let's talk a little bit about the Fed. Given the data we're seeing, given the labour market data we're seeing out of the United States, given the fact that we're likely to see strong inflation prints coming through later this week, when do you think the Fed is likely to deliver its first cut? How far out will it be? Will it be this year? Could it be next year?
We do expect to see it happening this year because we do expect the economy to slow down this year. But of course, as you're saying, right, it all depends on the trade war and exactly how that continues. What we're currently seeing is that there's still a lot of uncertainty, which is having a grip on the market, having a grip on companies. It's keeping investments low. And as a consequence, we expect to see that the economy in the second half of the year will show signs of weakness. And that may be a plausible moment for the Fed to begin cutting them.
What are you expecting out of the trade talks that are going to be taking place in London this week, though, between the United States and China? How are you factoring that into your thinking? The expectation is that actually we're going to have to see these talks lasting for a while. There's a lot of detail that needs to be delivered upon. We're looking for a catalyst, but do you see an easy win coming out of these talks? What do you see being the next milestone that you're watching for in the trade story?
Yeah, it's incredibly hard to tell, right? So we're seeing we're probably strongly going to look at what is going to happen when it comes to scarce resources, right? Materials. So that will matter a lot to us, but it's really difficult to tell where these stocks are going. I wouldn't say that there's one specific thing that we're looking for, but we do expect to see improvement simply because the trade relationship is so important for both countries.
And Marika, just finally on the BOE, we heard from Megan Green over the weekend in Dubrovnik. You've seen this tick up in UK inflation recently. Do you agree with her, though, that disinflation will continue, that there are unlikely to be second-round effects on wages here?
Yeah, well, again, I would say also for the UK economy, it's not that strong that we would expect to see a lot of wage pressure coming in. So I find her comments understandable. Yes, I would say that.
OK, Marika Blom, ING Group Chief Economist, we thank you for your analysis, as always, this morning. You mentioned those trade talks. They're going to be our topic of discussion next. The US and China ready to resume talks in London. We'll see just how the markets are reacting. Allspring Global Investments' Lauren Van Billion joining us next. This is Bloomberg. 30 minutes away from the start of the opening trade. Welcome to the programme. If you're just joining us, we've got futures pointing lower on both sides of the Atlantic as we head towards these US-China trade talks taking place in London today. Of course, the S&P already crossed that 6,000 threshold on Friday off the jobs report, the important psychological threshold. What will be the next catalyst to take it past that again? Looking at your bond space, we've got Treasury yields on the 2-year lower 3 basis points, lower on the 10-year as well, but a touch higher on the 30-year. But of course, we've got some key Treasury auctions coming up this week, and we shall discuss now with Lauren Van Billion, fixed income portfolio manager over at Allspring Global Investments. Good to have you back, Lauren.
Yep, good to be here.
I mean, this is going to be a crucial test of appetite for US government debt. How significant would a bad auction in either the 10 or 30 years notes be?
Highly significant, particularly given that it's the longer dated maturities we're going to see this year at auction. And we know how much anxiety there is out there around longer-term financing, around government interest payments as a percent of GDP or percent of budget. So, yes, this is going to be key. It'll really set the tone into June as a whole, I think.
I mean, when you're thinking about the big, beautiful bill and this revenge tax, Section 899, how much do you think that it actually is going to drive foreign investors away from US debt?
It's difficult to say right now in its current form. We know that bill still has a lot of fairly long road ahead of it, probably a fair number of revisions before we see its final form.
So basically breathe easy because it's not going to pass Section 899.
Or at least maybe don't trade on it quite yet,
right.
Which I think is the story we're seeing in the market as a whole. I think people are unwilling to take too big a position ahead of key data or key events. And that's why you can kind of see moves, quite big, quite quick moves in the wake of any sort of release.
What's the takeaway from last week? Payrolls numbers were strong. Bond markets, I obviously took a little bit of fright from that. What is your sense of what the shape of the curve is telling us about the US economy?
Yeah, I think the move last week was interesting because the whole curve moved as one, right? And I think the last few weeks the story has been far more either that, the steepening, either bond or bear, bull or bear, depending on the particular data release itself. In fact, the whole curve moved was interesting to me. But if you take a step back, 10 years at 450, right? Yeah. Pretty much mid-range.
30 years nearly at 5.
30 years nearly at 5. I thought that close above a weekly close above 5 would have been significant, but we have come back down again as well.
Sure.
But it still talks about that range-bound trading, right? It's a fairly wide range, and things can move really quickly within that range. But we haven't seen a decisive break out of any of these.
So what's the catalyst this week? You've got trade talks taking place in London. You've got the auctions that Lizzy was mentioning. You've got inflation data coming through. UMich is out on Friday. What are you looking for this week in terms of the catalyst?
I mean, auctions are going to be huge. Inflation data is always going to be important, although I feel the market has become a little bit more comfortable with the inflation story.
Do you think the Fed's comfortable with the inflation story?
Well, that's a different story entirely. The Fed has to jawbone that it's watching things carefully, of course.
Yeah, but it's got a solid labour market at the moment to work with. It's got an inflation story that's pushing kind of higher.
Yeah.
Does it need to worry about the labour market? Can we park that one for now? Do we need to focus? Is the Fed going to be focused on the inflation data? We're hearing more and more Fed speakers talking about their concerns around those numbers, and we still haven't, you could argue, seen the full effects of the tariff narrative coming through.
And we won't for a while, right? Because the tariff number goes up, comes back down, it gets delayed, it comes back through. Trade talks with China could be significant for the final form of trade tariffs as well. The Fed is doing what it needs to do, which is telling that story of we're in control, we're looking at things, but don't get too carried away in pricing in cuts just yet, right? Give us time, give us space.
Okay.
So basically back to the big theme, do you expect this move away from US assets to continue to get bigger? Is it going to turn from trickle to exodus?
The auctions will help us, I guess, have a short-term view on that, right? Are we still seeing that marginal dollar being put to work in the US or further afield? I think if you're talking very long-term in terms of asset allocation.
And I am, yeah.
Yeah, that is interesting because I think you've seen active managers tilt one way or the other. Certainly at Allspring, we've been active there. But what you haven't seen as yet, I think, is asset owners thinking about their sort of high-level strategic asset allocation or mix. And those can be very long decisions. Those can take a good long while to think about and to allocate to. That would be significant.
But I mean, when you hear, Christine Lagarde, Panetta, Starmer talking about the euro taking over from the dollar, if the right conditions are met, does that sound realistic to you?
It would take a couple of decades, right? It's not a quick it's not a quick outcome. The dollar's privilege is still that deep and liquid market. And yes, so the marginal buyer is perhaps becoming less convinced or a little bit more cautious. But how do you move away from the US in a meaningful way, talking a really 10, 20% of your portfolio? That is going to take a much longer time to play out.
Are people comfortable with the European picture, though? Germany, I keep trying to put Germany to one side, because Germany is the only kind of country that feels like it's got fiscal space at the moment. France doesn't. Italy doesn't. If we're concerned about the US deficit, aren't we concerned about the European deficit?
Yeah. It's interesting, yes, because it's similar themes. But I suppose, Europe has the tailwinds at its back of, rates are a lot lower.
Yep.
And I think one thing perhaps that people haven't been looking at is, I think there's potential for a lot more Asian investment into Europe. And into European sovereign bonds. If you look at, say, European bond yields hedged back to a variety of currencies, they look incredibly appealing, right? Hedged back to dollars, hedged back to yen, hedged back maybe even to the Korean won. So you could be seeing a case building there for offshore investment into European financial assets based purely on the income they can receive right now, with perhaps potential for capital gains.
So that's not a concern about the US, it's just I can get a better deal in Europe.
Absolutely, absolutely. And I think a lot of the macro picture for Europe into the year ahead, we've seen a lot from the ECB. I think they'd like to probably stop where they are.
Yeah.
But I think there's probably more downside risk from here than upside, right? To both inflation and growth. So maybe we see a little bit more from the ECB, although I wouldn't
not a lot more.
Wouldn't bet on it.
Yeah.
But while you're waiting for that potential, there's that income to earn. And I think investors need to be thinking about income that they're earning while they're waiting for other capital gain stories to play out.
In the UK, we get the jobs and GDP data this week. I mean, how much more could, if that shows resilience, I'm wondering how much higher the pound could go if you see that resilience illustrated in the data.
I mean, yeah, the UK has been very resilient, hasn't it? That with wage numbers, growth, employment numbers. I suppose maybe a great textbook example of when labour supply gets a little bit constrained by certain other geopolitical events, what can happen to your domestic labour force. I think BOE would still like to cut further, but they're not going to hurry. But yes, I think another strong reading out of labour markets, wage data could be very good for the pound.
OK, so back into this week, we've got a lot of catalysts between now and then. Is the danger at the moment that bond yields break to the top or to the bottom of the recent range? What gets us out of the range? And is this week going to be the week in which we could potentially see this? Would a catastrophic auction get us out of the range? Would a super strong inflation print out of the United States get us out of the range? What gets us out of the range that we're in at the moment?
I don't think this week is enough to get us out of the range, quite frankly.
Okay.
A 10-year at 450 is probably about mid-range, right? I would want to see it up at 475.5 before we're talking about a real break of a range. And we're just not there yet.
Is that more likely than getting to the bottom of the range?
I certainly am still in the camp of steeper curves. So, yeah, to me, the longer-dated bonds, the risk still feels higher than lower. But it depends on your time horizon, right?
Yeah. Always. Investment time horizon, very important. Lauren, nice to see you. Thank you very much indeed. Lauren Van Bion, fixed income portfolio manager at Allspring Global Investments. Thank you very much indeed. Coming up, the US and China are ready to resume trade talks in London today, with the flow of rare earth minerals and chips maybe to be key focuses that we will watch for. We will have details on that story. It's coming up next. This is Bloomberg. "17 minutes to the market open this Monday morning. The trade talks in London are absolutely front and centre right now, Lizzy. We've got the Chinese coming together with the United States in the British capital. Expectations are reasonably high, but it feels like we're kind of sort of coming out of the acute phase of this process and into the kind of the chronic phase of this process, which takes longer to resolve, more difficult. You've got to learn to live with it for a little bit longer. And it feels like that's the bit we're into now. We're haggling about rare earths and chips, and we're talking about market access. We're not even talking about tariffs and that kind of thing yet. We've got a deal until August. July the 9th, obviously, is coming up for a lot of other trade deals as well. The market's optimistic. but I think we need to see evidence to support that optimism this week. And are we going to get it is the key question.
Yeah, we're really in the weeds here, and that's why you've got the lower-level negotiators still. Besant, Lutnick and Greta. But, you know, they're here to, as you say, discuss the detail, whether that's on critical minerals or whether that's on student visas or whether that's on not chips tariffs but chips as well. Yeah. And you had these positive signals over the weekend. You know, China saying on Saturday it had approved some applications for rare earth exports. Trump saying that she had agreed to restart the flow of minerals and magnets using the materials. So now they just need to stretch that out and make it into a longer-term deal. But then the question is, what's the US going to concede in order to get that over the line?
This has to be a pretty big climb down, isn't it? The chip issue has been a really big one. And I'm just wondering whether or not the Trump administration is really ready to move that far on that. The rare earths story out of China is clearly a key area of strength. How much are they prepared to give at this point?
And that's their leverage.
Yeah.
And yet, when you look at the China data this morning, we've talked about the deflationary picture. You know, it's the fourth time straight that you've seen a deflationary, that you've seen CPI falling. It's the 32nd month of factory deflation. So, you know, when you have the tariffs really kicking in, you've got job losses, income losses, and people wanting to spend less, and factories and service providers having to cut prices. This is what's really going to push Xi even more to the negotiating table.
Katya, yeah, absolutely. Katya Dmitrieva joining us now out of Hong Kong to discuss this. Katya, from the Chinese side, just give us a sort of sense out of Hong Kong what people are looking for.
Well, from China's side, they basically want what they've wanted from day one, which is the elimination of tariffs. You know, things are a bit more complicated now. Of course, the U.S. has started to expand into other regions. It's not just tech, it's also now students, for example. And so what China is really aiming for here is a removal of all tariffs, as many tariffs as possible, as well as restrictions on something that you guys were just talking about, which is these technology, EV, renewables, as well as chemicals that were recently imposed. So it seems like every month there was something new out of the White House when it comes to restrictions on China. And as we saw today in data, it's a huge, China's taking a huge hit to its economy when it doesn't have the ability to export these goods. And there's also, of course, the economic impact globally. With a slowing global economy, it means less demand for China's goods as well. So sort of the end goal here for China, like the thing that would be the most, the best outcome for them would be an elimination of these tariffs and more open trade.
So that's the big picture goal. As you say, China already taking an economic hit, but it's got the leverage of critical minerals. What's it likely to actually give away? What's it likely to need in terms of a concession from the US? What's the realistic outcome of this week?
Yeah, the point about realistic is an important one there, because although these trade officials are meeting today, and there's sort of a delegation from both China as well as from the US, not the leaders themselves, that should be noted and that you noted earlier. And what they're hoping to establish is really just, you know, they have this basis for negotiations going forward. There was this upset after Geneva with China and the U.S. going back and forth, trading barbs. So right now, what the U.S. would like is that opening up for the rare earths minerals and these critical minerals that go into everything from laptops to phones and EVs. And so once that flow is restored, which China on Saturday said it has allowed a few contracts to go through, then that could sort of be a basis for more talks. But are we, our markets, our economists expecting sort of a big final agreement out of this? Probably not. You know, we're still in that 90-day window. There, you know, the higher tariffs are still hanging over China, and so it remains to be seen. But certainly it's a positive, more positive than we were last week, that these talks are even taking place in London this week.
Absolutely. S&P's at 6,000. That tells you all about the positivity that's being priced into these markets. Katya, thank you very much indeed. Katya Dmitrieva joining us on the Hong Kong side and the Hong Kong view of what is happening in London today with these trade talks. Let's get a market perspective on all of this. Bloomberg Executive Editor for Asia Markets, Paul Dobson, joins us now. Paul, what are traders looking for out of these talks? How high are expectations? Are we going to see some kind of a catalyst coming in the same way we saw out of Geneva?
Hi, good morning, Guy. Well, I think that the market is going into these trade talks with a reasonably optimistic view of where we are right now. We can see that in Asia's markets today, with their equities are up, performing well. China's gauge in Hong Kong moving into bull market territory. So, you know, plenty of optimism there. And I think we have seen that thawing, particularly when it comes to the rare earth minerals, magnets from China. The signs that there might be opportunities for further progress this week. On the other hand, you know, we don't know how in-depth these talks are going to be, what their sort of remit and scope is, and how much of a breakthrough there'll be from that. So I think that the traders will be happy on the most part and continue to sort of look favourably on the talks, so long as there isn't any acrimony, so long as there is some progress and some deal and some agreement and some signs that the talks are going to continue. And, you know, by the way, if they continue going all the way through the week in London, then that will probably be seen as a reasonably favourable thing as well. So some optimism. I don't think the traders are looking for too many specifics. I guess each sector has its own wish list. But from a top-down perspective, at least, it's more the idea that it's a friendly tone that continues to sort of come from these conversations.
Good mood music heading into it, Paul. Just put the China data into context for us, though. It came out this morning. How bad is it that it's going to push Xi to make meaningful concessions this week?
Yeah, I think that, you know, the export numbers to the US, obviously very striking, particularly considering that it's only half a month that the tariffs were in place. But on the other hand, there was pretty much, you know, flows of goods were grinding to a halt around that time. And by the way, China did still manage to eke out overall year-on-year growth for its exports, with some flows of goods going through transit countries and so on. So not entirely a disaster, but the economy is looking a little bit bleak at the moment. I've got this word for you that people are using a lot now, involution, talking about the idea that price competition in China is so intense, for example, among the electric vehicle manufacturers, that it's actually kind of, you know, unproductive rather than helpful for the economy, not driving efficiencies, but just kind of squashing everything in its wake. So there are reasons to be kind of worried about it, at the same time as reasons to, you know, kind of like see some hope as well there.
Paul, final quick question. End of this week, what is the biggest catalyst? Is it the trade talks? Is it the inflation data out of the United States? Is it what is happening in terms of the auctions? Is it the Michigan data we get on Fridays? What are you looking for this week in one word?
Yeah, from our perspective, it's all about those trade talks. We're going to be focusing on them from Asia more than anything else, I'm sure.
All right, Paul Dobson understood the assignment. Bloomberg Executive Editor for Asia Markets, we thank you. And remember, you can get up-to-date analysis and insight from Paul and the rest of the team. Just go to MLIV Go on your terminal. Let's go from the macro to the micro. Joe Easton is here with our stocks to watch. Joe.
Morning, Lizzy. So we've got some takeover news for a UK company. This is Alphawave, listed here in London now. It's a maker of semiconductor connectivity, communications equipment, and it has actually got a bid come in from Qualcomm in the US, the big US chip giant. Now, this company actually IPO'd back in 2021 at around 400 pence a share. We can see the stock hasn't done well at all. It currently trades at around 150. The bid is at 180, so this stock set to rally at the open of trading, 183 specifically the price on that one. So we're going to see a big boost in this stock, but some of those longer term investors still not really getting much of a return, actually making a pretty much a big loss on that IPO price. But one to watch today. Then we've got Telefonica also on the radar, looking to do a deal for Vodafone Spain. Now, Vodafone Spain was actually acquired by Zircona Communications, which is also listed as well. That one is listed in London, so that one could actually see a big boost. It's a private equity company that invests in communications and probably going to get a rise in that one today. And we'll also look at Telefonica as well, potentially going to be teaming up with Massa Orange for that Vodafone Spain Spain business, about 5 billion euros that's worth. So pretty big. Then I'm also looking at luxury following the data that Paul was discussing earlier. I've kind of got my eye more on the imports side of the data because it was weak, down around 3%, the third consecutive drop in monthly imports into China. So that could hit luxury. We've seen a bit of a drop down in Prada. It was down around 1.5%. It has come up a little bit in Hong Kong, but potentially we might see some weakness in LVMH, Kering, Burberry, Moncler, all the usual suspects in the luxury space. Might be a little bit weaker following that Chinese data. Keep an eye on the sector this morning.
Joe, great stuff. Thank you very much indeed. The Alphawave story, I think, is really interesting. It's just another, Joe was talking about that, just another listing that is going away. We've seen recent listings that are going towards the United States. That's obviously a huge concern. But here is a takeout, and we've seen plenty of them. London is really struggling at the moment from a listing point of view. And this is just another example of it. Really, shocking liquidity, shocking ability to maintain its listings, the wrong kind of mix in terms of the stock story. The dividend yield is pretty epic right now in terms of what you see for the London market, but it's underperforming what we're seeing out of Europe as well. London's up this year, but it's not up as much as the rest of Europe. What is it going to take? When does the Labour government, when does the government in the UK start to actually make a meaningful shift here that's going to get this story going? Taxation, is that one reason you could make a change? That's something that they would struggle with right now. What else can the government do right now?
It can change its regulations.
Yep.
I mean, it's going to be a topic at London Tech Week this week. I've got a panel with the Bolt CEO later this morning. They're still making their mind up about where to list. Do they pick London? What does Reeves do on regulation?
Why would you pick London? Yeah, precisely. Why would you pick London? You've got a liquidity issue, you've got a research issue. The US offers many things. There are challenges with the US now, but why would you list in the UK as a tech company?
It's something we're going to be talking to Sharon Bell later on in the programme, but she talks about how Section 899 is going to encourage UK corporates to consider relisting in the US. Definitely a theme that I want to pick up with her when we get to her. But we're coming up to the market open. We've got futures pointing lower, both sides of the Atlantic as we inch towards it. Eurostoxx 50 futures down 0.2%. To stay with us, we'll take you all the way to the European Open. This is Bloomberg.
Monday morning, big week coming up. Lots of things to think about. Couple of minutes to go until the opening trade here in Europe. Let's talk about the legacy out of Friday. Remember, Friday was the day where we dealt with payrolls. A stronger than anticipated payroll number out of the United States. The US labour market certainly isn't rolling over, and you saw that being priced into equities. The S&P finished Friday at 6,000. We're at 6,000 again. That's amazing considering the backdrop that we're watching here. But the optimism in the States is certainly something to pay attention to. Europe went out around here. Little bit of a tailwind maybe coming through. We rallied into the close in the United States. But actually, in reality, the futures are probably telling us a picture of caution this morning. So let's take a look at what the numbers we are looking at. Eurostoxx 50 down by 0.2%. The FTSE's absolutely flat as a pancake. DAX futures flat as a pancake as well. It is Whit Monday. You've got a number of markets that are going to be closed, so just be aware of that. I think you've got the Swiss market closed today. I think you aren't going to see much trade in Novo Nordisk today either. Copenhagen, I think, is closed as well. So just be aware of the fact that you are going to see maybe some liquidity coming out of the market as well. So that's the picture going into the week. A flat one, a fairly flat one, but a lot of catalysts to think about this week, Lizzy, in terms of the macro story. What are we seeing with single stocks today?
Well, we need to keep an eye on Alphawave here in London. Qualcomm agreeing to buy the semiconductor company for about $2.4 billion in cash to expand its AI tech. We also have this Bloomberg scoop over the weekend that Telefonica and Orange have held informal talks on a potential deal for Vodafone Spain. And this morning, Telefonica hiring AZ Capital to analyse that potential deal. We've also had the WPP CEO, Mark Reed, announcing his retirement. So we'll keep an eye on all of those stocks when we get the open, Guy.
OK, let's pay attention to what is happening with this open Monday morning. Does it give us a sense of direction? I'm not sure it's really going to give us much of a sense of direction. So markets are open. The opening trade is upon us. FTSE 100 doing absolutely nothing, going nowhere in a hurry. We were expecting this market maybe to pop a little bit higher, 0.2%. Not really anything that you can hang your hat on, though. And what you're seeing basically is an incredibly flat open. As I say, it is Whit Monday, so there are kind of holidays to factor into your thinking as well. The stock 600 flat as a pancake, no action there. We'll see how long it takes the CAC and the DAX to get open. Feels like a very sleepy start to a big week coming up with some massive auctions that we need to be watching out for. We've got trade talks taking place in London between China and the United States to factor into our thinking as well. CAC opens down 0.1%. DAX opens down by 0.3%. The Dutch market down by 0.2%. But I think the market is sitting, waiting for those catalysts, Lizzy, maybe to emerge midweek, and there's a lot of them before we get a clear sense of direction, certainly emerging for equities, which, at least globally, sit at elevated levels, you could argue.
Yeah, so let's break it down by sector across the European continent. We've got about half of sectors in the green this morning. Travel and leisure at the moment leading the gains, but it's only up about 0.4%. Basic resources just stealing the lead, about the same amount up as well. Bottom of the basket, though, you've got tech down 0.5%, autos and parts as well in the losers category this morning. Just a couple of those names that I was mentioning earlier. We've got WPP shares down 0.7%. After we had the announcement that the CEO, Mark Reeves, looking to retire, and they're looking for a successor now. This, of course, one of the world's biggest advertising agency groups. I also mentioned Alphawave, because we've got Qualcomm agreeing to buy Alphawave for $2.4 billion in cash. Alphawave shares up 2.9% at the open, so embracing that deal, it would appear.
Let's just kind of pick up on that and think about what is happening there. What does it take to get the London market moving? FTSE 100 is underperforming, continues to underperform. It's up on the year, but in a week we've got London Tech Week coming up, when we're kind of focusing on London, trying to figure out what is happening. Trade talks are happening here. What is it going to take to get the London equity market moving right now? Because it doesn't feel like it's the big focus. The Labour government is making some changes, but are we going to see enough of the kind of the regulatory unleashing that they talked about a couple of months ago in order to get the market moving?
I mean, you could argue that they haven't been radical enough when it comes to getting growth, right? They had 14 years in opposition to come up with a blueprint, some big ideas, and yet so far we just haven't seen that kind of growth that they promised was going to fund infrastructure investment in the UK. We've got the industrial strategy now having been postponed.
Yeah.
It was going to be on the same day as the spending review. It's now going to come at the end of June. We're waiting for big ideas from this government. Absolutely.
Well, let's try and figure out where those big ideas come from. Sharon Bell, Senior European Equity Strategist at Goldman Sachs, joining us around the table. So Alphawave, like another delisting, another stock leaving London. The London market's had an OK performance so far this year, but it's underperforming. What does it take to get this market moving? Should investors be looking at it and saying, actually, here is a heavily discounted market still that I can invest in?
Yeah, absolutely. I mean, it's underperformed the rest of Europe largely.
Yeah.
Obviously, Germany, the DAX has done extremely well with a big fiscal spend. But, of course, the UK government doesn't really have that option. You can't really do a large fiscal spend at the moment when you've got such a tight budget. And I think that the big issue for the UK stock market, though, is not so much economic growth in the UK. It's more the lack of domestic investors that want to put their money into risk assets like equity.
Yeah.
Many years ago, pension funds, insurance companies used to be the big buyers of UK equities, and now that's not the case.
In Europe, we're starting to see European investors taking their money out of the States and bringing it back to Europe. Why is it not? It's not happening here.
It's not happening here. So in the case of Europe, I would say absolutely. I mean, European investors have spent the last 15 years taking money out of Europe and putting it in the US. But the last few months, absolutely right, they've been doing the reverse. They've been going back domestically into Europe with that better catalyst that you're getting from more fiscal spend in Germany. We're not seeing that in the UK. We're not seeing UK domestic investors come back to the UK market. It's really actually, I mean, the UK market's also been bought this year, but it's been foreign investors actually that have seen the value in UK stocks rather than domestic buyers.
Yep.
I was speaking to the Chancellor last month, and she said never say never when it comes to mandating pension funds to invest in UK assets. And then we had the announcement that the UK does actually plan to require pension funds to invest in private markets and the domestic economy. Do you think that actually mandation puts people off? That it has the opposite effect? If you've got to mandate it, it can't be that good.
Yeah, I mean, I understand exactly what you mean. You need to get... I find that the markets globally that have the highest valuations are the ones with what I would describe as the most domestic buyers and domestic bid and domestic ownership. And the UK used to be in that situation and no longer is. And it's a little bit of a chicken and egg situation. If you don't have those domestic buyers, you don't have the good growth stocks that want to list, that expect to get a good high valuation. And then if you don't get those list, then equally domestic investors don't want to invest there because they think, well, there's no good growth stocks. So it really is trying to remove the UK from that vicious cycle, but it's quite difficult to do so.
So maybe the catalyst comes from the White House. I was interested in your notes to see that you're saying Section 899 could encourage UK corporates to consider relisting in the US. Sorry, it's the other way around. That could, could even make it
look,
even worse.
I think it's a combination of things. So Section 899, if you're 50% or more US owned, then you shouldn't be subject to the extra taxation. Therefore, how can you get yourself 50% or more US owned? Go stateside in terms of your listing is an obvious way to do so. Although there are many listed UK companies which are already skirting that 50% anyway, could easily get there even without relisting. But I think the other thing that Section 899 does is if I am a European or UK investor and I am worried about my dividends when I invest in the S&P being taxed more because I'm a European individual and I might be subject to this Section 899 tax, I might decide actually it's not worth it and I'm going to invest more in Europe or the UK. So I think there are two things here. One is what the corporates do, and if you're a substantial business with a big US presence, you might want to relist, or you might want to up that US shareholder base. Alternatively, you're an actual domestic investor in Europe, and you invest in the US, then actually you're worried about my dividends being taxed a bit more, and that makes Europe look a bit more friendly as a place to invest in.
You talk to a lot of investors. Where are their heads right now on this? Are they just waiting to see what happens in terms of the legislation?
Yeah, I mean, their heads, obviously, it's a huge week this week, as you point out, loads of macro data points. The key thing, I think, for investors at the moment is a potential trade deal or not between US and China, and also US and Europe as well. We haven't yet signed a trade deal there. So, those things, super uncertain still.
In terms of where equity markets are, though, the S&P's at 6,000. I find it amazing, given all of the tail risk that exists right now, but equity markets in the States continue to do very well. And I'm wondering we get to the point where actually European investors just have to look again at what is happening and have to get pulled back into that narrative.
Yeah, do you not have FOMO over the summer? If the S&P keeps going up, you don't want to miss out on this.
No, you don't. I mean, look, to be clear, though, Europe has still outperformed the US
by a long way.
By quite some way. So it's not as if we need worry about that right now. I think the US is having a little bit of a catch-up. That's fair enough. I do agree, though, US back up at 6,000. Given all the risks around, that seems like quite a quick move upwards. And we think if you look at, say, beneath the surface, cyclicals versus defensives, they seem to be pricing to us about a pace of economic growth in the US around 2%, which is high, considering all the risks at the moment, considering all the data that we're getting. Even with those slightly better payroll figures last week, we've still got very weak survey data. ISM, manufacturing services has been weak recently. So I think growth pace in the US is probably, more like 1.5%. If that's the case, then the market's slightly overpricing at the moment.
But you've got the July 9th deadline. All sorts of trade deals could be done before then and push it even higher stateside. As I say, surely what you want is just to be in on that action, not sitting on the sidelines.
Yeah, although there are risks. You've seen the volatility. I mean, we talk about the market having recovered the Sharpe ratio this year. So if you look at performance divided by volatility, it hasn't been fantastic return at all in US equity. And at the moment, of course, you can get a good yield on US treasuries. You can get a good yield on cash.
Everything yields the same as far as I can tell.
We're seeing money market flows very, very strong, which you can view either way. You can say, well, actually, that means investors are going into other safer forms of investment. Or you can view it as, wow, there's this huge embedded amount of cash, which is on the sidelines, as people might say, that could re-engage in the equity market if they see risks come down. But, risks are still very high, and we haven't yet seen the economic damage, not properly, of this trade uncertainty.
But everything does yield the same. I'm getting basically the same yield on equities as I'm getting in bonds, as I'm getting in money market funds.
But equities are riskier.
I agree. In theory, equities and credit should be riskier, but they're all kind of delivering the same number at the moment. The differentiator appears to be currency, which I find amazing.
That's a fair point, yes. That's a very fair point.
And I'm just wondering if the euro continues to appreciate from here, this is the question I keep asking, because the numbers are just amazing. The S&P is it's at 6,000 and it's up 2% in dollar terms, but it's still down by 7.5% in euro terms. If the euro keeps appreciating, does that just encourage European investors to bring money home?
Yeah, ironically, because I think there is this expectation that if you've got your currencies rising, that's bad for your companies, particularly as European-listed companies are very international. They make a lot of dollars. Yeah. So you might see, actually, the second quarter earnings season be hit a little bit by that sort of translation effect. You're making a lot of dollars, you're translating that back into sterling or to euros or to other European currencies, and they've all gone up. But yet, as an investor, I mean, a lot of European investors, when they invest in the US, invest unhedged, because that's absolutely been the right thing in the last 10, 15 years. You want to invest in the S&P and you want to invest unhedged because actually the dollar has gone up, and now both of those things have not happened this year.
Talking of euro strength, though, this isn't necessarily what's driving it. If the ECB doesn't cut again this year, how much does that hold back European equities? Or does it, if it's actually a growth story?
Yeah, I don't think...
story?
No, my view is it wouldn't. We do actually expect it. I know there was a slightly more hawkish ECB meeting. We do still expect the ECB to cut. We expect them to cut now in September. We had previously expected July. So, yes, we pushed that out. And it's become a lot less certain, I agree, with all of that. But I think if they don't cut, it will be because of better economic growth. And that will be, on balance, much better for equity.
Good news is good news. All right, Sharon Bell, lovely to see you. Senior European Equity Strategist over at Goldman Sachs. Sharon Bell, always a pleasure. Well, let's check on some of the individual stocks that are on the move at the open. Joe Easton is here with those. Joe.
So we have got a big move in Alphawave today, giving us some excitement on what is pretty much a quiet Monday. But this one getting a takeover bid from Qualcomm in the US, worth a couple of $2 billion. Now this, as we said earlier, is a company that makes the communication systems and the semiconductor materials all linked in to the semiconductor space. A supplier, really, to the sector is what Alphawave is, and it's listed in London. Went public back in 2021, was part of the big cohort of London IPOs in 2021 that has actually underperformed. So the stock IPO'd at around 400 pence 4 years ago, now coming up today to 181, the bid price at 183, so a big move up, a big move higher in terms of the gain today. But over the longer term, really suffered in terms of the returns on that one. But Alphawave, really the big move up today. Then we have got the telecom space in the radar as well, that news of a potential deal for Vodafone Spain, Telefonica and Massa Orange, the unit of Orange, or the part-owned company, looking at that business. That is owned by Zegona Communications, only actually seeing around a 2% gain in that one at the moment. Telefonica not really giving us much to cheer about at all. We've got a big unch on that one, so no movement on that one, but Zegona a little bit higher, so potentially feeding through. Then WPP in ad space, of course. Mark Reed stepping down after 7 years at the helm of one of the world's largest advertising companies, coming as a bit of a surprise judging by that share price. So seeing a bit of weakness. They have been trying to turn it around in terms of a decline in advertising spend, particularly by the tech companies. So this potentially just more uncertainty for WPP, with Mark Reed standing down. So that one is down at 1.4% here in London today. Then I had my eye on defence, because actually I was looking more at luxury following the China data, but defence really the weakest sector today. Now, traders were reminding me that some of this is a bit of a catch-up play, because Sweden was closed on Friday, so Saab coming down almost 5%, catching up with declines on Friday. We did have a note out from Deutsche Bank saying that all the positivity on defence spend possibly priced into the market. So actually we saw weakness on Friday, kind of catching up. But we are seeing Hensoldt in Germany, Dassault in France also lower, BAE a little bit as well. So that's really the weak sector for me today. And then finally in Germany, there was a little bit of a move lower in Fresenius. They are facing a recall of one of their devices that is used for transmitting medication to patients in hospitals. The US FDA recalling it on the highest level of recall, saying saying could actually be potentially a little bit dangerous. So that is recalled. Fresenius was called a bit low. It's only down 0.1%. Pretty quiet market in terms of the movers, but Fresenius a little bit lower in Germany this morning.
Joe, great stuff. Thank you very much indeed. Paris Air Show this time next week. The defence stocks will be firmly in focus as we all gather at Le Bourget. Joe Easton joining us on all the equities we're watching this morning. Up next, we're going to talk a little bit more about what is happening with the European equity story. Got a little bit more banking activity. Portugal's fourth biggest lender, Novo Banco, attracting bids from BPCE and CaixaBank. We're going to discuss what the acquisition would mean for cross-border banking deals in Europe, even in the Iberian Peninsula. That's what's next. This is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session and equities not doing much. The Stoxx 600 weaker 0.1%. So let's dive into a particular sector where there is some action happening, and that is banking. Bloomberg has learned Lone Star's Portuguese lender Novo Banco has attracted two bids from French banking group BPCE and CaixaBank of Spain. A preliminary decision on a winning bidder or taking the IPO route is possible as early as this week. So let's get more on this. We're joined by our Portugal Bureau Chief, João Lima. João, just tell us what's coming next in this sale process then.
Hi, Lizzy. So basically, there's various options open, as you mentioned. We've reported that there were two bids received, BPC and CaixaBank of Spain. And then there's also the IPO. The possible IPO, and what we've reported in the past, the Novo Banco CEO has said that Lone Star will likely want to keep all options open, as further down the process as possible. So we're expecting this will take, we don't know exactly. We reported that the decision could come as early as this week, but at the moment that's where things stand. All options open in terms of the two bids and the IPO as an option also. Just to give you an idea of size, JB Capital said in March that Novo Banco could be valued at between 5.5 billion and 7 billion euros.
Let's talk about the significance of this and what it would mean for Portugal, what it would mean for Europe, like a cross-border deal. We haven't seen many of those.
Right. For Portugal, this bank comes with a lot of history. It used to be Portugal's biggest publicly traded bank, Banco Espírito Santo, which was then rescued and broken up, and that's what led to the formation of Novo Banco about a decade ago. So if Lone Star decides to go for the IPO option, and for Portugal particularly, this will be significant. It'll be Portugal's first major IPO in 4 years and the biggest since 2008. So it'll be definitely a big mark in terms of IPOs. Looking more broadly, across Europe, as you've mentioned, governments in the region have tried to hamper deals recently, both within borders, like Spain opposing the takeover of Sabadell by BBVA, in Italy also, and then Germany, as you know, has said it's against the potential acquisition of Commerzbank by UniCredit. So if this goes ahead, it'll be an important mark. If BPC or CaixaBank get to buy Novo Banco, it'll be an important mark in terms of cross-border deals in Europe. In Portugal, the finance minister has said that Spanish banks shouldn't further increase their presence in the country. That obviously singles out CaixaBank, which already has a unit here. But it's not a position against takeovers per se. He's mentioned specifically being against the Spanish banks further increasing their presence by acquiring Novo Banco. So yeah, if this deal does go ahead, it'll be an important mark in Portugal and across Europe.
João, great stuff. Thank you very much indeed. Portugal's Bureau Chief here at Bloomberg, João Lima, joining us from Lisbon. Let's kind of talk about, I broaden the lens, figure out what is happening with the euro. I'm not sure how you quite make this connection, but we're going to do it anyway. Valerie's here to talk about the euro. We're at 114. OK, so let's just talk about the kind of context of where we are.
Up 12%.
We're up 12%. The dollar is on the back foot, yet US assets are doing relatively well. I kind of pull this all together. People at the ECB are talking about this being the kind of the euro's moment. Yeah. Valerie smirks and smiles. How big a shift would it require to take some of the halo.
We just heard from our reporter there in Portugal, Joao, talking about how complicated it's been for European banking consolidation. And if the euro really does want to be, compete with the dollar in terms of a dominant player for a reserve currency, it needs deeper capital markets and it needs a more liquid bond market. Joint issuance. That was another thing that ECB Schnabel brought up this weekend. If they really do want to capture this window of opportunity, deeper bond markets and a more consolidated banking playground is really something that's going to need to draw more foreign capital into Europe.
So there's work to do in Europe. Meanwhile, S&P E-minis now over the 6,000 level. It's remarkable, really, as we're constantly debating, Val, that the stocks, US stock rebound continues. Of course, we had the payrolls data on Friday. But when you're looking at what's on the docket for this week, what could dent that rally?
I do think a lot of it is down to these China-U.S. talks going on today in London. I think that for the market to really trade strongly off of this, there needs to be some sort of hint that this meeting is laying the groundwork for a Trump visit to China. We haven't even heard a confirmation from China that Trump was actually invited to China. It's something he claimed after they had a phone call, 90-minute phone call last week. So that's a really key thing for the markets. Again, we do have a lot of other things to contend with. The bond auction on Thursday will be a big one. Not only we also get CPI as well. The market might overreact to any small hint of goods inflation coming out of CPI. But we also have to keep, the labor market in mind. Friday's payroll report, really surpassed people's expectations. Immigration really does play into that in terms of keeping the unemployment rate at a steady level. We know that deportations have been happening. That really will cause maybe some labor market tightness and might be the thing that could postpone those Fed rate cuts. Many people think that it's the unemployment rate that needs to tick up in order to invite those Fed cuts in this face of tariff-induced inflation that they're worried about.
OK, Valerie, we thank you. Bloomberg's Valerie Teitel there. And I want to pick up on that immigration theme because the tensions in Los Angeles have escalated over the weekend amid these protests sparked by sweeping US immigration raids with fresh clashes between law enforcement and demonstrators. You can see them now. President Trump and California's Governor Gavin Newsom are trading barbs over Trump's deployment of the National Guard. Newsom calling the action a serious breach and demanding Trump rescind the order, and Trump defending the move.
We're going to have troops everywhere. We're not going to let this happen to our country. We're not going to let our country be torn apart like it was under Biden and his auto pen.
What's the bar for sending Marines to...
The bar is what I think it is. I mean, if we see danger to our country and to our citizens, we'll be very, very strong in terms of law and order. It's about law and order.
What we're seeing in L.A. is chaos caused by the administration. People should exercise their right to protest. That's their First Amendment right. But people should also exercise that right peacefully. We do not want to play into the administration's hands.
For more, let's talk to Bloomberg senior editor Bill Ferries. Bill, you heard from the president there threatening to send in the Marines. Just talk us through the legality of all this. He's already sent in the National Guard. It's the first time since 1965 as presidents deployed the National Guard without being asked by the governor first. Just bring us up to speed on the latest.
Yeah, I mean, as you pointed out there, the White House says it authorized the deployment of 2,000 National Guard troops to Los Angeles and California. It sounds like only about 300 of those have been deployed so far. It is a highly unusual move. The last time we really saw it was during the civil rights era when state governors were opposing the reintegration or the integration of schools there, and the White House stepped in. Talking about having the Marines go in would be even more unusual. There's a U.S. law from the 19th century, the late 1800s, that basically bars the deployment of the U.S. military on American territory against its own citizens. So I don't know that we've ever seen anything like that, and I don't know that we will this time. But I think the rhetoric really shows where things are going, and we've seen protests get more violent later in the day, and that's where people are trying to see if they can de-escalate somehow this situation that's become more tense.
Bill, great stuff. Thank you for the update. We'll look forward to what happens a little bit later. Bill Ferries on what is happening in LA. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. As you can see, it's red across the screen for European equities so far. We're waiting for those US-China trade talks taking place in London today. Particular underperformance, as you can see, for the DAX in Frankfurt. And if you look at it on a sectoral basis, tech is the bottom of the basket this morning, down 0.5%. And that is where we're going to go to next. The UK Prime Minister Keir Starmer is set to appear alongside the Nvidia co-founder, Jensen Huang, at London Tech Week today. They're going to mark an agreement in which Nvidia helps the UK train more people in AI and expands research at universities. Across it all is Tom McKenzie, who's at the event for us. Tom, just talk us through what to expect from London Tech Week. Really, it seems quite the feat that Keir Starmer's secured this sit-down with Jensen Huang.
Certainly this is a feather in the cap for the Prime Minister Keir Starmer, who, as you say, will be joined on stage at around 9:05 UK time, so we're counting down to that. At the stage just behind me here in Olympia, of course, in West London. And we're expecting to hear some announcements around Nvidia's commitment to the UK market, whether it's training up people for that AI revolution over the next 5 to 10 years, whether it's committing more money to their R&D centre. But we're going to be hearing from other executives as well, other teams globally who are coming here to London to double down on what the government hopes will be that AI shift that can power and lead to growth that, of course, they are so desperate to see. And it comes at a time, of course, when they're putting more money aside for science, technology and innovation, something that I've been speaking to people on the ground have been broadly welcomed. There's a lot more that needs to be done, of course, when you think about the capital markets, when you think about scale capital, seed capital to get companies started up, not such a problem here in the UK, but it's that growth and that scale funding that's so important. So yes, we're going to be listening to whatever Jensen Huang has to say. He then goes off to Paris, interestingly, so there's a bit of rivalry between Paris and London. He's going to be at Viva Tech there as well, so we're watching for that. And then towards the end of the week, Founders Forum. But let's get to our guest right now, somebody who's very well placed to talk about some of these themes, really with a finger on pulse in terms of the venture capital and the fund flows. And that's Erin Platts, the CEO of Octopus Ventures. Erin, thank you for joining us here, of course, at London Tech Week. What are you seeing in terms of fund flows into AI here in the UK? How strong is that? How convinced are you that the UK is positioned for this theme?
Yeah, firstly, I would say absolutely optimistic and really confident that the UK has a right to win from an AI perspective. So in terms of capital flow, AI has been one of the drivers of venture capital in the UK for the last number of quarters. And we're seeing that mostly at the application layer level, but whether it be the talent that we've got in our universities, like I said, the capital that's going into this particular space, the hype is real, the buzz on the ground is absolutely there. There's some challenges that come with that, but I think we should be pretty optimistic around our ability to create some global category leaders out of the UK.
Okay, so the hype is real. What do you say to your portfolio founders who come to you and say, look, the US is now a significant market for us. We're not getting the growth capital we might need to really scale. We're going to go to the US. We're going to double down there, and maybe that's where we exit. Do you stand in their way, or do you encourage them to stay in the UK? What do you say? What are the solutions?
I think there is a bit of both. So what we usually find is our UK companies, they first need to scale and get product market fit in their home market. So whether that be the UK or a combination of UK and Europe. And where there's always, it's good to have rivalries across the different tech ecosystems. Collaboration is key. So what we usually recommend is companies get a little bit of scale before they go to the US. The US is a huge, absolutely mission critical market, and we would never get in the way of our companies, but they have to be ready. They have to be ready from a product perspective, a depth of capital, and the ability to attract world-class talent in the US. And that's where we've seen companies fail, is when they go too early, they don't have the right access and network, and they end up usually hiring the wrong team. So the U.S. will continue to be a massively important nexus and market for our innovation businesses, but we need to make sure that they're prepared for it.
And where, for Octopus Ventures, where in that AI tech stack are you finding the most value right now?
Yeah, so we're sticking in that sort of AI application layer. So if you think about the amount of capital that's needed for more infrastructure plays, from the average UK domestic fund, and we're about $2 billion of AUM, we really want to be staying at that application level. And what we're seeing is companies that are really going vertically deep into one particular sub-vertical. So whether that be fintech on personalization, healthcare, so we've got a really interesting company we just invested in called Lyrebird that's taking clinical data and clinician data to make doctors more efficient. legal services, so a company, Intensify, that we've invested in. Again, really expertise to go in to make a workflow more efficient, more accurate, and more cost effective. So that's really where we're spending a lot of time and seeing really fantastic opportunities, but B, growth. And I think that's really a really important indication of sort of that product market fit.
The time frame between founding and getting that initial funding and exiting has stretched from 7 to 8 years to about 15 years.
Yes.
What is that doing in terms of the liquidity squeeze?
Yeah, it's tough. So I would say exits across the global venture capital and private equity ecosystem continue to be constrained. Now, there was some decent news data in Q1 in the UK, but it's I think it was the second best quarter in 12, but it's still marginal gains. So this sort of stagnation around exits is just making everything more difficult, because it means that venture investors are needing to find liquidity to be able to raise their next round, which is putting capital constraints on for new investments going into founders. So this is a topic that every single investor is looking at. Now, the positive sort of side is looking at macro data. So interest rates coming down. This is a big driver of this ecosystem. The number of US IPOs, usually UK and Europe, is a laggard from the US. So that's all really positive stuff that we're keeping an eye on, and hopefully we'll start to see some unlock. I wouldn't expect anything dramatic before summer, but maybe going towards the end of this year into early next.
I want to draw on your experience, formerly as CEO of HSBC Innovation, but also at the coalface in terms of thinking about the UK capital markets and how to reform them, because you're working with Julia Hoggart and others on an advisory board linked to the London Stock Exchange at a time when we've seen Wise, for example, moving its primary listing, or at least think about moving its primary listing to the US. We've seen what's happened with companies like Darktrace taken over by private equity in the delivery space as well, Deliveroo. How much concern is there right now that the capital markets are not fit for purpose?
Yeah, so I'm always of the mind where if there's an issue, you can either throw stones or you can lean in and try to be helpful. So I joined the Capital Markets Task Force earlier this year in the aim of how can I help? How can we as an ecosystem come together, because we have to have a vibrant, healthy public market.
I mean, how urgent is this?
I would say it's really urgent. So you can look at every single one of those cases and explain it, right? It probably makes sense for the company, the shareholders, whatever. But thematically and from a cumulative basis, we really do need to find ways to continue to drive much more capital into our public markets, make sure there's reduced friction going from private to public markets, and at least be competitive with other global capital markets. And then if you layer on AIM, and there's a 30-year anniversary of AIM coming in, there's also needs to be a conversation around not just main market, but AIM, and really how do we drive capital and growth into those markets. And there's no silver bullet, right? I think there's a suite of interventions, many of which have been talked about around looking at regulation, looking at how does Mansion House Accord now actually not just fuel private but public markets, but we really need to see a change immediately.
Are you seeing the impact of those Mansion House changes now? Is that starting to come through?
Not yet. In pockets, I would say real positivity with respect to the Schroders Phoenix joint venture that was created. There's a lot of good momentum with respect to British Business Bank, but not the actual capital going into the funds at scale yet. I still think we'll need to see another 12 to 18 months. But if we don't start to see the outcomes in that time frame, I do think that we'll need to look in the mirror and figure out, why aren't we seeing the outcomes we expect from this? What is a fantastic and positive initiative?
And for the reference for our viewers, of course, part of this is about a non-compulsory agreement amongst many of the pension providers and funds to invest a proportion into UK markets around infrastructure and taking on higher risk, and tech may fit into that. Does there need to be a compulsory agreement, or at least a compulsory piece of policy that comes through to compel pension funds to invest more in this space?
It's an interesting question, and my personal view is not yet. So with Mansion House Accord, so this is kind of 2.0, we actually saw more pension funds than DC pension schemes sign up. I think it was 11 versus maybe 5 or 6 the last time, and actually signing up to a higher percentage of their contributions, from going from 5 to 10%. So I think there's a willingness and desire and and the pension funds I speak to an excitement about deploying capital into this vibrant ecosystem. So I think we need to wait maybe another 6-12 months, and then from there we'll have to keep all the options on the table.
Okay, so this time next year we'll check back in with you on this. Before I let you go, deal volume as you project out 6 to 12 months, what's that looking like?
So deal volume is going up, but it's bifurcated, right? So we're personally seeing, although the data is flat, huge excitement in the pre-seed and seed round. So we've got our own first check fund, which is going unbelievably well. But then you start to see this lag in sort of Series B, Series C, and then growth rounds getting bigger and much more just larger and more sizable. So you're seeing that barbell approach. So I think we'll hopefully start to see an uptick. Again, I think it's slow and steady for the next couple of years. I don't expect a huge uptick like we saw in 21 and 22, but hopefully slow and steady, much more diversification of funding sources into a broader range of companies is, I think, will show that we're on the right track.
Okay, Erin Platts, really excellent insights. Thank you very much indeed.
Thank
The
you.
CEO of Octopus Ventures, with a feel in terms of some of that liquidity challenge when it comes to startups here, what to look for in terms of some of the growth opportunities as well within the AI space, how the UK can lean into that. Guy, Lizzy, back to you.
Bloomberg's Tom McKenzie, we thank you. And a reminder that Bloomberg Tech, Tom's show, Bloomberg Tech Europe, launches later on this week. You're not going to want to miss it. The first episode coming at 6:30 a.m. London time on Friday morning. So do stay tuned for that. I want to stay on tech, though, because Bloomberg has learned that Meta is in talks to make a multi-billion-dollar investment into artificial intelligence startup Scale AI. The investment could exceed $10 billion in value, and Matt Bloxham, Bloomberg intelligence analyst, joins us now for more. Matt, just tell us why Meta's betting on Scale AI. Is it just because the CEO was Sam Altman's roommate?
Yeah, hopefully it's a little bit more than that. I mean, I think what we're seeing with Meta is that they're looking to extend their reach into all parts of the AI world, and people might not be familiar with what Scale AI does, and it kind of operates in what I'd call the unglamorous part of the AI industry. It basically employs humans to train and label the data that's used to train the AI engines. And actually, we do a lot of that at Bloomberg too. So, you're trying to help the machine understand what it's ingesting. And historically, that used to be kind of very simple. And I think Scale AI was, caught to some controversy around where it was employing people and how much it's paying them in other parts of the world. But increasingly, they're employing PhDs to kind of do much more sophisticated training of these models, testing them, setting quite difficult, complex tasks for them, and then essentially grading them on their answers. And that helps the models to kind of get more sophisticated, reduce hallucinations, and open them up to more sophisticated applications in the real world. So I think that's really why Meta is interested in increasing its investment in this business.
There's a great story in the terminal today talking about the idea that the Chinese are turning off their AI models while the exams are on, which is amazing.
Tell your teenagers, Guy.
I have to say, it's a big feature of the landscape, I have to say, these days, with exams and revision. So I find that story absolutely amazing. Apple, though, feels like it's still out of it. We've got this big event coming up this week, and you're just not getting the buzz around Apple in the way that you are with other businesses.
Yeah.
Any way that gap gets closed this week?
I don't think so, no. Yeah, we've got the Worldwide Developer Conference later on today, and I think people would be hoping for a big splash on the AI developments, but I think that's going to play second fiddle to something much more familiar to us, the operating system, what you look at on your phone every day. And I think it's going to be quite a big radical shift. So we're going to all have to get used to how to work our iPhones again once this new operating system
I don't have this problem, by the way.
comes out. Yeah, and I think they're doing that because the hardware isn't really evolving at a particularly great pace. So a good way to kind of stimulate fresh demand for your phone is to create a new operating system that needs faster processors, bigger memory, so that you upgrade to a new phone and they can keep the sales momentum going before maybe next year.
So this is a precursor. Where are we in terms of Apple phones now?
We're at 16, so 17 this year is going to be, I think, another kind of relatively modest upgrade.
Okay.
And I think the kind of, the 20th anniversary is 27, I think, and that's kind of where maybe the speculations are leading up to a much kind of bigger...
We're looking all the way out that far?
Yeah, I mean...
In terms of getting... the market doesn't like to wait that kind of length of time.
No, they don't, but, I guess depending on what they say about the OS today, I think the market will get that, software is a really important part of the ecosystem and that they can probably do a lot to kind of maintain, if not enhance, the appeal of the platform.
The problem is that increasingly software is spelled AI, and that's kind of...
Yeah, and it's going to be a soft AI event for them, for sure.
Absolutely. Matt, great to see you. Thanks very much indeed for stopping by and updating us. We'll look forward to that event a little bit later. I know we've got some great coverage coming up. Matt Bloxham from Bloomberg Intelligence. What are we going to talk about next on this show? Will the UK Chancellor of the Exchequer, Rachel Reeves, have to raise taxes later this year? We're going to look to the government spending review. It's due out later this week. We're going to have some of the details that we're anticipating in that review next. This is Bloomberg. Welcome back. Welcome to the opening trade. Welcome to Monday morning. There is not a lot happening when it comes to the equity markets, certainly here in Europe right now. At the moment, we are barely budging on the FTSE 100. We are down less than 0.1%. The CAC 40 is down 0.1%. The DAX is down a whopping 0.3% this morning. So there's a lot of activity happening out there, but it is basically feels like we're basically in a situation where we're waiting. Monday is going to be a kind of wait day. Are we going to see some details coming out of these trade talks? We are waiting for obviously big events coming through midweek in terms of the auction, the CPI data out of the United States. Got plenty of things going on this week, just not this Monday morning, which is why Valerie's going to be here for the rest of the show to kind of set us up for the rest of the week and give us an idea of what we should be focusing on. I struggled to see a lot of activity on the screen in front of me this morning.
Yeah, to me, it's the U.S.-China talks, which I know we're going to get to speaking about in just a moment, but that's key for the equity market today.
But I don't know when we're going to see a result from that.
Yeah, exactly. No, that is a good point. I mean, hopefully there'll be a readout at some point later today, but, you know, the equity market has rebounded so strongly because trade policy uncertainty has dropped so rapidly, and I think today will be a key test in whether that continues.
But basically, do you think that the market's hopeful heading into these talks? Because the market's
I think so. I mean, look, Lutnick's there, Besant's there, Jameson Greer is here. You know, they brought the A-team. So I think that sets us up for optimism, frankly.
I don't know which one each of the A-team, each of those characters
Who's
would
on
be.
the B-team?
I don't know. I don't know who's on the. I don't know who is on the B-team. Let's talk a little bit about what else is happening as well, because we've got the spending review this week as well.
Yeah, so that's happening on Wednesday here in London, and the UK Chancellor Rachel Reeves may need to raise taxes again later this year because of the weak growth in the UK economy. She's also got higher borrowing costs and increased spending on public services. But I have to say, her overhaul on the UK non-dom tax regime is already spurring some wealthy residents to leave the country. And I've been speaking to someone who really personifies that change. So Gary Landsberg sold the Mayfair Arts Club, and then he opened a new private members club in Milan, the Wild. So here's part of our conversation on the latest episode of Wall Street Week.
Well, I think, you know, for someone that was pretty much heavily invested in London, I'm completely divested from London. I have nothing here. I have a few real estate investments, but I'm certainly not looking at this stage to invest back into London in the short term.
So you've got this move of the rich and internationally mobile from London to Milan, partly because of what Milan is offering, Italy as a whole, this flat tax regime of €200,000. It went up from 100,000 to 200,000, and really spelling a nightmare for the UK when it's dismantling the non-dom regime.
Another policy that the UK government, the Labour government, put in place and is now struggling to deliver upon, and that's but that's the spending review writ large. This is just emblematic of a wider challenge. They came in with a kind of a unconvincing plan that is frayed at the seams and is now starting to come apart. And the evidence of that is going to become, I think, pretty clear this week in terms of the numbers we're going to see from Rachel Reeves.
Yeah, because it's going to be such a difficult choice between all of those ministers who are asking for more money for their departments, and she's going to have to say, I'm prioritising health and defence. But, you know, with the non-dom policy, I spoke to her about this. She was convinced that you're not going to have this wealth exodus from the UK. In that film, we spoke to the Centre for Economics and Business Research. They say if more than 1 in 4 non-doms leave the UK, it's going to cost the Treasury more than it raises, this policy. So even more of a nightmare, self-created by the Chancellor.
Are we going to get to that number? Or are you already at that number?
We're not already at that number, it doesn't look like yet. But when you look at the anecdotal evidence of people going...
They're still trying to sell their houses before they leave. They're having a bit of issue with that.
They've got to do that. But look, there's not just Milan, there's Monaco, there's the Middle East, and everybody's in this global competition for the rich and wealthy, and mobile.
So I think the next kind of piece of this is going to be students, I think, which is going to be really interesting. The US is putting students off travelling? Does Imperial College, does Oxford, do Cambridge attract people into the UK as a result of that? Or does actually a more hostile policy from the UK on students actually present challenges as well? So I think there's a kind of various ways of looking at this. It's a multi-fronted story in terms of the way that the UK is positioning itself at the moment, and it feels more hostile. You've also got the school fees story. There's plenty of things, I think, that are putting people off right now. Let's talk about the trade story that Valerie was just mentioning as well. What is going to be key this week in terms of the way that the markets are set up? US and China negotiators are here. Apparently it's the A-team that are here. Where are we talking about trade, or are we actually talking about other things? Beijing's rare earth export restrictions, chip exports, students actually maybe a factor as well. The Trump administration wants to restore the flow of critical minerals, but what does it need to give up in response? That is the key question.
Those exports of critical minerals have been getting released at a rate that is, higher than it was, but not as high as we believe we agreed to in Geneva. And President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys and the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up, and then we'll clear up what you don't like that we've agreed to release on our side.
Kevin Hassett's speaking on what is happening with the rare earth story and kind of where we are in this process. Brendan Murray joins us now, leads our global trade coverage. Brendan, we're not even talking about trade anymore. We're talking about trade in other things. This isn't about, tariffs. This is about rare earths and chips and students. And the picture gets more confusing by the day in terms of the relationship between these two.
Yeah, exactly. So both of these delegations now have a mandate from their leaders to make progress in these talks. So both sides have arrived here over the weekend to London. They have no incentive to have these fail. So I think what we can see is a couple things. First, on substance, both sides need to get those critical supply chains rolling again. Yep. The U.S. for its in magnets and rare earths and those kinds of things, and China wants access to the technology that it needs to develop its artificial intelligence industry. So I think they're going to sit down at the table, hammer those two things out, make sure they're on the same page, and then the second thing is the style or the tone of these talks. Can they sit across from each other? Howard Lutnick, as was mentioned, is here. He's the sort of more tough-talking New York finance guy. Scott Bessent is the more diplomatic as Treasury Secretary. Can they sit across the table from their Chinese counterparts and set an agenda over the next several weeks where they can see they can make some progress on very difficult issues? The U.S. wants to move it. The U.S. wants to move very quickly. China, has an incentive to slow things down.
Valerie, if we don't get it, time is a real issue here. Yeah. How quickly does the market need to see something coming out of this?
Look, I mean, that's a hard one because we did get that China export data today that showed exports to the U.S. did fall by some 30%. It's not a trade embargo that some were worried about. So maybe that gives them a bit more time, and that trade is happening, at least in the month of May. But I do think that it's going to be important on whether this does lay a groundwork for a Trump visit to China. I think that's what could really boost equity markets.
In terms of kind of, if they last longer, is that a good thing? What I can't work out is if they're here for a long time and they're talking about a lot of things, is that a good thing? We're kind of talks are ongoing.
Surely it depends
on
the little snippets that come out of it. Yeah. When Lutnick gives a little voice.
Are they going to talk? Are they not going to talk? Are they going to brief? They're not going to. I don't know.
Well, a joint press conference would be nice, but I doubt we're going to get that today. It'll be kind of an individual readout from either of the parties. I think that's what Brendan expects as well. Yeah,
Brendan, great to see you. Thank you very much indeed. Valerie as well. Lizzy and I wrapping the show up. I just want to tell you what is coming up next. Jensen Huang is going to be in conversation with the UK Prime Minister. We're going to bring you that live from the conference that Tom Mackenzie's at down in Olympia. That's coming up next. This is Bloomberg.